If you're over 60 and you still hold money in a standard checking or savings account, there is something critical you need to hear. The sentences you speak out loud at the teller counter can shift a perfectly ordinary transaction out of the routine stack and into a flagged one. And the most alarming part is the piece your bank will never bother to explain to you. Certain completely common phrases spoken in a totally normal, well-intentioned way are enough to trigger an automated compliance review on your account, sometimes before any human being has even glanced at your file. You do not have to do a single thing illegal for this to occur. You do not have to be concealing funds, avoiding taxes, or violating any regulation whatsoever. The system has no idea who you are. It does not know you spent 30 years as a school teacher, that you lost your spouse, or that you have never once overdrawn an account in 4.5 decades. It recognizes only patterns, and right now, the patterns it monitors are things that ordinary people say every single day without giving them a second thought at bank branches all across this country. This is not a problem unique to one institution or one region either. Every federally insured financial institution in the nation runs some version of the same software, constructed around the same federal regulations, scanning for the same small collection of patterns. A tiny credit union in a rural town of 2,000 residents uses essentially the same compliance triggers as a massive national bank operating branches in every single state. My name is Lana Mains. I work on behalf of taxpayers directly before the Internal Revenue Service. There is no version of this conversation that your bank will ever voluntarily begin with you. So today I'm going to give you 3 specific things, the 3 precise phrases that push a routine transaction onto that radar. The reason retirees get caught by this system more than any other demographic, and the 5 steps that cautious retirees take before any large transaction, so their money remains exactly where it belongs, in their name, in their account, available on the day they actually need it. None of this demands a lawyer, a special type of account, or anything remotely complicated. It simply requires knowing the rules that no one ever hands you while you're standing at the teller window. Stay with me all the way to the end, because that final section is the part no one ever walks you through, at no cost, and it is genuinely the part that keeps your account protected. Let me begin with the first phrase, the one that tends to surprise people the most. It is any statement that signals you are aware of the $10,000 reporting threshold. I want to skip the extra paperwork. Can we keep the amount under the limit? Is there a way to handle this so it doesn't trigger a report? Even something as brief as "I'll just return tomorrow for the remainder," said in reference to a deposit, lands in exactly the same category. Even mentioning it casually, with a teller in a warm, friendly exchange, does nothing to make it safer to say out loud. Here is what is happening beneath the surface. Under the Bank Secrecy Act of 1970, your financial institution is required to file a currency transaction report anytime a cash transaction exceeds $10,000. That report includes your full name, your social security number, your address, and the precise amount and time of the transaction. And it is submitted into a federal database. That report is considered standard. Millions of them are filed annually for entirely ordinary reasons, and most banks will simply tell you it is a legal requirement because it is not treated as a secret. It is also worth noting that the $10,000 figure was established in 1970 and has never been adjusted a single time for inflation. Using a rough consumer price index estimate, $10,000 in 1970 translates to somewhere between $75,000 and $80,000 in today's dollars, which is a large part of why a standard retirement-related transaction can appear on paper like the kind of amount the regulation was originally designed to address. The report that actually is kept secret is an entirely different document called a suspicious activity report. It carries no minimum dollar amount whatsoever. It can be filed on a transaction as small as $500, and by law, if one is filed against you, the bank is prohibited from informing you. You will never be made aware of it. Saying anything that frames your transaction around that $10,000 number pushes you toward that second hidden report, because it can be interpreted as structuring, which is a separate federal offence under Title 31, Section 5324, and it constitutes a crime even when the money involved is completely and entirely legitimate. Here is where most people have it wrong. Back in 1994, the Supreme Court actually ruled in Ratzlaff versus United States that prosecutors were required to prove you understood that structuring itself was against the law. Not merely that you were aware of the reporting requirement. That protection survived only about as long as it took Congress to take notice. Later that very same year, legislators rewrote the statute with the specific purpose of eliminating that protection. Today, prosecutors are only required to demonstrate that you intended to avoid the report. Nothing beyond that. This is not hypothetical. In 2013, the IRS seized nearly $33,000 from Carole Hinders, a 67-year-old restaurant owner from Iowa, solely because her routine cash deposits consistently came in under $10,000. That same year, convenience store owner Lyndon McClellan had his entire account balance of $107,702 seized through the exact same mechanism. Both individuals eventually recovered their funds, but only after years of legal struggle, because under civil forfeiture rules, the government is permitted to seize the money first and then require the account holder to prove their own innocence afterward, with no criminal charge ever being filed. Congress did ultimately respond by passing a 2019 law that now requires the IRS to connect any structuring seizure it retains to an actual illegal source of funds, which represents genuine progress. But it does nothing to prevent a seizure from happening to you in the first place. The most straightforward way to stay off that radar is to never frame your own transaction around the reporting threshold out loud to anyone at any point. The second phrase is the one that penalises you for being genuine. It is volunteering language that happens to align with a recognised scam script, even when absolutely nothing improper is occurring. My grandson is in serious trouble and needs this wired today. I connected with someone online and he needs help getting back home. A contact told me about a guaranteed return opportunity in cryptocurrency. Someone at the IRS is helping me relocate my funds somewhere more secure. Even a variation like the people from Microsoft are helping me transfer my account somewhere safer follows that identical script. Even a phone call placed to your bank using these same words, rather than appearing in person, activates the exact same review process. Here is the painful irony. In 2018, Congress passed the Senior Safe Act, which extends legal immunity to trained bank employees who report suspected financial exploitation of any customer aged 65 or older. Read that once more carefully. It does not compel the bank to report you. It simply eliminates any downside risk they face for doing so, which means many banks actively train their staff to flag this precise list of phrases the moment they hear them. Financial institutions have clearly embraced that incentive with enthusiasm. In 2021 alone, banks and credit unions filed more than 72,000 suspicious activity reports connected to suspected elder financial exploitation, an increase from 62,000 the year before, according to FinCEN's published data. And this system does not exclusively catch genuine scams. It also catches a retiree who sold a vehicle to a private buyer through an online listing, or someone legitimately wiring bail money to a grandchild, or an individual moving personal savings into Bitcoin through a fully regulated exchange. Not one of those actions is against the law. The words just happen to align with the established pattern. The solution is not to go silent. It is to swap out the specific trigger language for plain and neutral alternatives before anything leaves your mouth. Online purchase becomes a private transaction. Cryptocurrency becomes a personal investment. My grandson is in trouble becomes a family gift. The third phrase is the one that almost no one catches until the damage is already done. It is refusing to respond to a teller's standard question. That is none of your business. I should not have to justify what I do with my own money. You are absolutely correct that it is your money. But under the Bank Secrecy Act's Know Your Customer requirements, the bank must be able to account for unusual activity appearing in your file, and a flat refusal is routinely interpreted as the red flag itself. Not because you did anything improper, but because an unexplained transaction is precisely what the system was designed to escalate automatically. Consider two retirees each withdrawing $9,000 for a roofing contractor. The first says home repair and is walking out the door within 30 seconds. The second says, that is between me and my contractor, and ends up receiving a call from the bank's fraud department later that same afternoon for the exact same perfectly legal withdrawal. Decades of loyal banking with one particular branch do not change this outcome in either direction. It simply is not a factor in how the determination gets made. So here is what I want you to be aware of. The exemptions, the credits, the refunds, the breaks that most seniors already qualify for, but have never once claimed. I have gathered all of them into one place, organised by state, listed form by form, so you do not have to spend hours searching through government websites. Everything is laid out quickly and clearly, so that any senior can identify exactly what applies to their situation. Regardless of which state you live in, there is money you are currently leaving behind. It is called the Senior Exemption Playbook. You will find it in the first pinned comment directly beneath this video. Just tap it one time and everything you need will be right there. Now stay right here because the next section contains the exact statement that protects you in every one of these situations, and it is the core reason I created this entire video. So here is the answer you have been waiting for. What do you actually say in the moment that satisfies all three of these concerns simultaneously? One sentence, truthful, brief, and completely unremarkable. Not silence, not an elaborate story. Here are the 5 steps that careful retirees follow every single time to remain on the right side of all of this. The first step is preparing one short, truthful sentence in advance, before any large deposit or withdrawal, personal expenses, a home repair, a family gift. Nothing referencing avoiding paperwork, nothing mentioning a limit. Settle on that sentence before you leave your home, not while standing at the counter. The second step is allowing a transaction above $10,000 to simply be what it is. Sign the standard form without any additional comment. It is ordinary paperwork, not an accusation. Treating it like something to conceal is precisely what transforms it into an actual problem. The third step is replacing the scam pattern language with plain neutral words before they ever leave your mouth. Online becomes a private purchase. Crypto becomes a personal investment. My grandson is in trouble becomes a family gift. The transaction itself remains completely unchanged. Only the words used to describe it are different. The fourth step is never refusing to answer a routine question, no matter how frustrating it feels in the moment. One sentence and you are finished. A flat refusal is what genuinely invites deeper scrutiny, not being straightforward and honest. If the questions ever feel like they have gone beyond what is reasonable, you can simply request to speak with the branch manager, which is an entirely ordinary request and does not carry the same kind of risk. The fifth step is gathering your supporting documentation before you ever walk through the door. A bill of sale, a written gift letter, an estate document, so that the source of the money is already established on paper the moment anyone raises a question. If you are planning something substantial in advance, such as a legal settlement or an inheritance distribution, reaching out to your bank beforehand eliminates the element of surprise that sets off most of these triggers in the first place. If a pattern in your own account statements looks like it might attract attention, this is also the right moment to have a licensed enrolled agent or tax attorney examine it with you before you proceed. That is the precise framework I walk my own clients through before any significant banking transaction. Now let me bring all of this together, because the common thread connecting all 3 phrases is the same one throughout. None of this is about concealing anything. It is about recognizing that an automated system reads your words for patterns rather than for intent, and that a small number of perfectly ordinary, well-meaning sentences happen to match the patterns that system has been trained to escalate. The solution is not secrecy, and it is not over-explaining yourself. It is one plain sentence, delivered the same way you would say it to any other person, with nothing in it that corresponds to a recognized trigger. You are not being asked to be dishonest, or to be cold, toward a teller who is simply doing their job. You are being asked to describe your own entirely legal transaction using the same straightforward language you would use with a next-door neighbour. It is the difference between answering a direct question and performing a rehearsed explanation. And tellers are specifically trained to detect which one they are receiving. No one at your financial institution is going to call you in advance and coach you through the appropriate words to use. The teller posing the question is not going to explain why the phrasing matters. Andrew Clyde, a gun shop owner from Georgia, discovered that reality in the most difficult way possible in 2013, when the IRS confiscated nearly $950,000 from his business account over a structuring allegation. It took him years of fighting, a partial settlement in which he surrendered $50,000 just to recover the remainder, and a piece of legislation named after his own case before Congress made even minor adjustments to the existing rules. He had not committed any crime. His deposit simply aligned with the pattern that the software had been programmed to detect. His experience stands as a reminder that good intentions and a long history of honest financial behaviour offer absolutely no protection once a pattern matches what the system has been trained to flag. The only individual who can guarantee you are using safe and accurate language at your own bank is you. And getting it right is far more straightforward than any part of what you just heard makes it sound.